All right, let's break down the anatomy of a pretty spectacular stock rally. We're talking about Acutaas. You might remember them as Ami Organics. Well, they just smashed an all-time high of 2,322 rupees. So the big question is, how? How did they manage to do that? Let's get right into it. So this slide really sets the stage for the whole story. First off, you've got that incredible 100% rally in just 8 months. Wow. And second, there's this major pivot. They've shifted from their roots in pharma into something called Tech-Chem. Basically, we're talking about really specialized chemicals for the tech and electronic sectors. At the helm of all this, CEO Nareshkumar Patel. You see, this is way more than just a stock price going up. It's a complete reinvention of the company. So the question is, how did Acutaas even get to this point? To really get what's driving this rally, we've got to go back a little bit. We need to look at their journey, because the whole context behind this rebrand, well, it's absolutely crucial.
You know, what's really amazing here is just how fast this all happened. They IPO'd back in September 2021 as, a pretty standard pharma company. But look at this. Just a couple of years later, in fiscal year 24, they're already getting into electronics R&D. Then comes the huge moment in May 2025. They officially rebrand to Acutaas Chemicals. That's them telling the world they're going in a new direction. And then, boom, less than a year after that, the stock is at a record high. That is an incredibly quick transformation.
Okay, let's move on to the bull case. What's the optimistic view here? Well, the company's strength, it's not just about all the new stuff. It's really built on two totally distinct pillars. You've got their rock-solid, established business on one side, and then these brand-new, super high-growth sunrise sectors on the other. Right, so pillar number one is what we can call their chronic therapeutic moat. Acutaas has some serious expertise in making really complex, hard-to-produce APIs. Those are the active pharmaceutical ingredients, the real guts of a drug. And they're doing this for tough areas like anti-cancer and Parkinson's. Plus, and this is a big deal, they've played the whole China Plus One strategy perfectly. As companies around the world look for manufacturing alternatives to China, it's creating massive opportunities for Indian companies just like Acutaas.
Now for the second pillar, and honestly, this is where a lot of the excitement is. They call it their dual sunrise pillars. First up, high-purity photoresists for semiconductors. This plugs them right into the India Semiconductor Mission, which is huge. And second, electrolyte additives for EV batteries. This is a textbook example of skating to where the puck is headed. They're not just making any old chemicals, they're making the very specific, super high-tech stuff that's going to power two of the biggest growth stories in India for years to come.
A great strategy is one thing, but you need the financial muscle to actually pull it off. And when you start digging into Acutaas numbers, well, you find a company that is absolutely firing on all cylinders. This slide really tells you everything you need to know about their operational excellence. Look at that, a record 32.7% EBITDA margin. Just think of that as a measure of how profitable their core business is. Now, to give you some context, their peers, companies like RT Industries or Vinati Organics, they're sitting somewhere around 18 to 20%. So Acutaas is way ahead. It's this best-in-class efficiency that's fueling that absolutely staggering 133% year-over-year growth in net profit.
So you're probably wondering, how are they paying for all this aggressive expansion? The answer? With basically zero debt. And that is huge. In an environment where interest rates are climbing, having a debt-to-equity ratio of just 0.01, it's like a superpower. It means they can fund a massive 350 crore rupee capex plan all on their own, from their own cash. That's why management was so confident they could upgrade the revenue guidance to 30%.
And listen, this isn't just some flash in the pan. The company has a solid track record. If you look back over the last 5 years, they've delivered a 41% compound annual growth rate in their profits, a 41% CAGR, and a capital return of around 21%. These are exactly the kind of consistent high-growth numbers that get big institutional investors very interested. Okay, so that's a pretty powerful bull case, right? But every story has two sides. So now we have to switch gears and face the single biggest risk for this stock right now, and that is its valuation. And this slide, well, it lays out the bear case in plain black and white. The stock is trading at a PE ratio of 64.5. So what does that mean? It means investors are paying almost 65 times the company's current annual earnings. Compare that to the industry average, which is just 26.4. Now that is a massive vote of confidence from the market, for sure. But it also sets an incredibly high bar. It means there's absolutely zero room for mistakes. So what have we got? An amazing growth story on one side and a very rich valuation on the other. So where do we go from here? Let's wrap this up by looking at the key things, the key catalysts. that the market is going to be watching like a hawk to see if this premium price tag is actually justified. At the end of the day, it all boils down to one thing: execution. The next huge test is going to be their Q4 results, and the market is going to be laser-focused on two key deliverables. First, how's that semiconductor chemical pilot ramping up? Is it on schedule? And second, have they started signing any of those initial offtake agreements for the battery additives? The answers to those two questions will probably write the next chapter for Acutaas. The rally was built on a whole lot of promise. The question now is, can the execution deliver?